How the US classifies your foreign company. Most US citizens who incorporate abroad don't realize their company is automatically classified the moment it's formed. The issue isn't where you incorporate, it's how the IRS categorizes you. Today, we are breaking down controlled foreign corporation rules, what legally creates a CFC, ownership threshold, family attribution, and why many single-member foreign companies qualify immediately. Because classification determines taxation. The legal foundation of a CFC. A controlled foreign corporation, or CFC, is not a rare structure. It is a statutory classification under US tax law. In simple terms, a CFC exists when a corporation is incorporated outside the United States and more than 50% of the company's total voting power or total value is owned by US shareholders. Now we define US shareholder. A US shareholder is any US person who owns at least 10% of the voting power or value of the foreign corporation. So there are two thresholds. 10% ownership defines a US shareholder. 50% collective ownership by US shareholders creates a CFC. This is mechanical, not emotional, not optional. Now let me explain the ownership thresholds clearly. First example, single owner. You are a US citizen, you form a company in Panama, you own 100%. You exceed the 10% threshold and US shareholders collectively own more than 50%. The result, your company is a CFC immediately. No election required, no special filing to become a CFC, it happens automatically. Let's look at another example. Two US owners, two US citizens form a UAE company. Each own 50%. Both exceed 10%. Collectively, they own 100%. Result, the company is a CFC. Last example, the third one, mixed ownership. A US citizen owns 40%. A foreign national owns 60%. The US person exceeds 10%, but US shareholder do not exceed 50%. The result is the company is not a CFC. However, reporting must still apply. Architecture requires precision here. Family attribution rules. This is where many people make mistakes. Under attribution rules, ownership can be constructively assigned between family members. For example, if a husband owns 100% of a foreign corporation and the wife is a US citizen, ownership may be attributed for certain tax purposes. Similarly, stock owned by children, parents, or certain related entities may be attributed. This means you cannot always divide ownership within a household and assume you fall below 50%. The IRS looks beyond paper structure. They analyze, control, and attribution. This is why international structuring without professional modeling creates exposure. Why single member foreign companies often automatically qualify? Most US entrepreneurs who incorporate abroad do so alone. They create a Dominican SRL, a Panamanian SA, a UAE free zone company, a Hong Kong limited. If you are the sole shareholder and you are a US citizen, your company will almost always be classified as a CFC. Many entrepreneurs believe it's foreign, so it's separate. Legally separate? Yes. Tax classification? No. The United States applies anti-deferral rules to prevent income shifting. The structure is seen. Form 5471 reporting. Once classified as a CFC, reporting obligation reporting obligations expand. The key form is Form 5471, information return of U.S. persons with respect to certain foreign corporations. There are multiple categories of filers. The most common for single owner structure is Category 5. Category 5 generally applies to U.S. shareholders of a CFC. This form is not a simple attachment. It includes balance sheet, income statement, shareholder information, Subpart F analysis, and GILTI calculations. Failure to file can trigger penalties starting at $10,000 per year per corporation, and penalties can escalate. International expansion without compliance discipline is financial negligence. Simple numerical modeling. Let's walk through a basic example. You form a foreign corporation. You own 100%. The company earns $200,000 in net profit. It pays 5% foreign corporate tax. Foreign tax paid, $10,000. Remaining profit, $190,000 retained. Now let's analyze. Is there Subpart F income? Does GILTI apply? What is the effective foreign tax rate? Can foreign tax credits often offset U.S. exposure? The analysis does not begin with how do I avoid tax? It begins with how will this be classified? Classification precedes calculation. Calculation precedes optimization. Strategic takeaway. Most U.S. citizens don't misunderstand foreign incorporation. They misunderstand classification. A company formed abroad is not invisible. It is categorized. And once categorized, it enters a structured framework of reporting and taxation. International mobility is not about geography. It's about alignment. So, before incorporating abroad, you must understand how your structure will be classified under US tax law. Because once it is formed, classification is automatic. And architecture cannot be built retroactively. I repeat, architecture cannot be built retroactively. In the next briefing, we'll break down why zero jurisdictions can still increase US tax exposure under GILTI rules. Until next time.